We're looking at a highly specific window opening for real estate in 2026. After a prolonged freeze, interest rates are stabilizing and starting to fall. Commercial real estate operates on a fairly simple seesaw with interest rates. When rates go down, borrowing costs drop, and property values typically rise. But during the aggressive rate hike cycle of the past couple of years, we saw something unusual happen. A massive valuation dislocation opened up between real estate and the rest of the market. This chart shows the S&P 500 pulling away, fueled by the AI rally, while the REIT index stays flat. REITs trade 5 turns below general equities. We've only seen gaps this extreme during the global financial crisis, the pandemic, and the current AI-driven surge. For investors, this setup offers a way to secure current dividend yields, while REITs still trade at these historical discounts, positioning a portfolio for whenever that valuation gap begins to narrow.
To understand those high yields, you have to look at how real estate investment trusts, or REITs, are structured. By law, they must pay out at least 90% of their taxable income to shareholders. That mandate consistently produces dividend yields that dwarf the broader S&P 500. And unlike buying a physical rental property, which requires massive cash down payments, closing costs, and dealing with late-night plumbing emergencies, you can buy a REIT on the stock exchange in seconds. Taking it a step further, REIT ETFs completely remove the headache of picking individual properties, but they introduce a new problem: product choice paralysis. If you're building a portfolio in 2026, your primary dilemma is deciding between a total market catch-all fund or a highly targeted large-cap fund. The specific vehicle you choose shifts your entire exposure, potentially concentrating your money in struggling sectors or creating redundant overlaps with assets you already own.
We'll evaluate the broad market approach first, anchored by heavyweights like Vanguard's VNQ and Schwab's SCHH. These funds offer massive scale. A single purchase gives exposure to over 160 companies, covering logistics hubs, residential apartments, and commercial retail. Tracking such broad indexes means incredibly low fees, with SCHH charging an expense ratio of just 0.07. On the other side of the spectrum is the SPDR Select Sector Strategy, primarily represented by the XLRE ETF. This approach applies a much stricter filter. XLRE restricts its holdings to the 31 largest, most dominant real estate companies in the S&P 500 index. Inside that list, you'll find massive weightings dedicated to modern infrastructure, specifically telecom cell towers and data centers. Because of that concentration, XLRE often behaves more like a tech infrastructure fund than a traditional bricks-and-mortar real estate portfolio. This concentration carries a slightly higher expense ratio and leaves out the mid-cap disruptors often responsible for high growth in the broader real estate market. SPDR real estate funds offer institutional-grade stability and direct exposure to the digital economy's physical backbone, but they completely sacrifice the defensive benefits of owning the broader market. If ETF averages aren't hitting your income goals, there is a third option: picking individual, specialized REITs. Take a company like Vici Properties. By focusing specifically on casinos and experiential real estate secured by long-term leases, they're able to target dividend yields well over 6%. But building your own portfolio requires intense calibration. You are now responsible for continuous earnings research, tracking interest rate sensitivities, and manually rebalancing your positions. You're also exposing your capital to single company failures, operating entirely without the safety net of an index. Individual REITs reward active management with outsized yields, but they force you to abandon the low-effort passive benefits that make ETFs so attractive to begin with. Landing on the right fund depends entirely on what your overall portfolio needs. If your goal is maximum diversification and paying the lowest possible fees, a broad market fund like VNQ or SCHH is your ideal vehicle. If you prioritize blue-chip stability and heavy exposure to data infrastructure, the SPDR XLRE ETF is the optimal path. And if you're chasing maximum yield in specific sectors, you'll need to step away from ETFs and pursue individual REITs like Vici. Accurately identifying your risk tolerance and how much effort you want to spend managing your money will impact your long-term wealth far more than chasing a tiny difference in expense ratios. There is one final critical pitfall to watch out for, especially if you consider yourself a broad market optimizer: portfolio overlap. If you already hold a massive S&P 500 index fund, deciding to buy XLRE to add real estate creates a structural redundancy. Those 31 companies in XLRE are already sitting right inside your core S&P 500 index. By contrast, adding a broad fund like VNQ introduces over 130 completely new real estate companies that exist totally outside the S&P 500. True portfolio diversification requires holding assets that actually behave differently than your existing core positions. REIT ETFs aren't identical commodities. The smartest investment in 2026 is simply the one that fills a unique, intentional gap in your overall portfolio. Look at this split-screen chart showing market valuations heading into 2026. On the right, the broader S&P 500 price-to-earnings ratio is climbing higher. But on the left, real estate investment trusts are trading at a 2% discount to net asset value. Despite this, operations project strong funds from operations growth, forecasted at roughly 6.5%. Capturing that growth comes with a specific trade-off. Real estate is highly sensitive to interest rates. If borrowing costs rise, property valuations fall. To navigate this risk without tying their capital to a single building or property type, both retail and institutional investors rely on exchange-traded funds. The 2026 market presents a clear opportunity to buy into discounted real estate assets, but picking individual properties is too dangerous. ETFs are the practical vehicle to capture this sector-wide recovery safely. 3 funds dominate this space: Vanguard's VNQ, Schwab's SCHH, and State Street's XLRE. At first glance, they look nearly identical. If you check their top holdings, you will see the exact same mega-cap companies leading the lists. When evaluating these funds, do not rely on traditional stock metrics, like earnings per share or PE ratios. Operating physical properties requires massive non-cash depreciation charges on the accounting ledgers. These charges artificially deflate reported earnings, making highly profitable companies look like they are losing money. The standard metric you need to use instead is funds from operations, or FFO. FFO takes net income and adds back that non-cash depreciation. This strips out the accounting noise to reveal the actual cash flow the properties generate from rent and leases. Evaluating a REIT ETF using standard stock metrics will lead you to misjudge its financial health. You have to look exclusively at funds from operations to see the real money moving through the portfolio. Vanguard's VNQ is the massive default option in the industry, carrying a 0.12% expense ratio. This graphic maps out the fund's extreme breadth. It holds over 150 different real estate stocks, capturing large, mid, and small-cap companies across the entire market. This total market approach means the fund owns everything from traditional shopping malls to specialized infrastructure, like these telecommunication towers. The downside to owning the entire market is that you are mathematically forced to hold struggling subsectors right alongside the top performers. VNQ provides a highly liquid proxy for the entire U.S. real estate market, meaning you accept absolute breadth at the expense of selective quality. Schwab's SCHH takes a more targeted approach and charges a rock-bottom 0.07% expense ratio. It applies a strict filtering mechanism. The fund holds about 120 stocks, but it explicitly excludes non-REIT real estate service companies to keep the portfolio focused purely on physical property owners. This line graph shows the compounding effect of fees over a 10-year period. A high fee eats significantly into returns, while SCHH's ultra-low 0.07% fee keeps the maximum amount of dividend yield compounding in your account. Because SCHH is market cap weighted, its performance is still heavily dictated by its top 10 holdings, despite having 120 companies in the fund. SCHH strips out real estate service companies and high management fees, allowing you to retain more of your yield while maintaining broad sector exposure. State Street's XLRE charges a 0.08% fee and restricts its investments strictly to companies inside the S&P 500. This creates an extremely concentrated portfolio, containing only about 30 real estate titans. This pie chart illustrates the direct consequence of that restriction. The top 10 holdings make up roughly 60% of the entire fund's risk profile. This concentration means you are heavily invested in massive, established operations, like corporate data storage and logistics facilities. By restricting the fund to the S&P 500, you completely remove exposure to the agile mid-cap and small-cap REITs that typically experience higher growth phases. XLRE delivers the stability of well-capitalized, dominant companies. You gain top-heavy safety, but you trade away the broader market's growth potential. When making a final decision, do not choose older, high-fee ETFs simply because they advertise a high service-level dividend yield. Over a 20-year investment horizon, a high expense ratio mathematically erodes your compound growth, costing you more than a higher starting yield will earn you. This comparison matrix lines up VNQ, SCHH, and XLRE side by side, comparing their expense ratios, total holdings, and core strategies. If you are a generalist investor, look to the Vanguard Fund. VNQ is the default, highly liquid, one-click solution for beginners who want to own the entire US market without overthinking it. If you are a fee-ruthless optimizer, the Schwab Fund is your target. SCHH provides nearly identical breadth to VNQ, but its lower cost structure mathematically wins out on capital retention over decades. Finally, if you are a blue-chip purist, the State Street Fund aligns with your goals. XLRE strictly holds the 30 largest real estate titans in the world, avoiding small-cap volatility entirely. Selecting a REIT ETF is not about finding a magic ticker symbol. It requires aligning your personal tolerance for concentration and fees with the specific mechanical rules governing the fund.